I saw this story this morning that you wrote on this, and I was kind of surprised by it. The fees on this are pretty high. What exactly is the point for investors?
Well, the idea is the name of these funds are called interval funds, and you can only withdraw money at intervals like once a quarter, once a month. And there are limits on how much people can withdraw. The idea is they can hold illiquid assets that are thinly traded, and you get an illiquidity premium. Because they're so thinly traded, it's costly to manage these funds.
What indication do they have that there's demand for this when everyone's been shifting to lower cost passive products? I mean, interval funds sounds a little bit like the active industry trying to, I don't know, hold on to what they have and hold on to their high fees.
Well, there's definitely a lot of that going on. On the flip side, though, there's a lot of growth in private equity. There's a lot of growth in private credit. There's a lot of growth in mortgage assets or other asset-backed securities that maybe sophisticated investors who don't have a ton of money would like to get access to. There is potentially a premium through illiquidity that these funds give access to that ordinary investors don't have when you have this daily tradable unit.
And so just to be clear, John, I mean, a big part of this is it's giving investors some sort of access to, I guess, assets that maybe they wouldn't normally have access to. But I'm wondering, when you talk about the potential risk and safety of these things, how protected are investors? I mean, particularly, since their money is locked up.
Well, I mean, that can be a protection, too. For example, in the UK recently, there was this run on a fund that had all these illiquid assets. So they were having to liquidate at fire sale prices. The idea of an interval fund is if there is like demand for people to pull money, it would slow it down, it would control it, so you don't have to sell at fire sale prices. One of the people I quote, Mike Arrighetti, head of Ares Management, he said, liquidity is kind of overrated, as they say. When you don't need it, you can get as much as you want. When you do need it, you can't get things at the price you want.